Okay, folks, we're going to get started in about 60 seconds. Please find a good seat. Make sure your coffee is refilled. Another exciting webinar today brought to you by Saks. Well, good morning, everybody. It is May 7th, and it's another beautiful day outside, clear weather. It's a little chilly outside, but still beautiful. So make sure you get outside today and take a walk or a run or a bike ride, whatever you want to do. Thank you for joining us. We're going to talk today about preparing for recovery, loan options, and forgiveness strategies. This is our weekly update, and boy, do we have some things to share with you today. This is our slide that basically informs you that we're just doing this for general guidance only, and it doesn't constitute the provision of legal advice, tax advice, accounting services, investment advice, and all the rest of the advice. Please consult your professional advisor on the specific and pertinent facts related to your particular situation, but we will be going over a lot of good stuff. And yes, we are broadcasting live from New Jersey, so hopefully there won't be too much interruptions from barking dogs and garbage trucks and fire alarms. So hopefully we'll keep that noise down to a minimum. And our agenda today is, of course, the introduction. We're going to talk about the Main Street Lending Program, Main Street New Loan Facility, the Main Street Priority Loan Facility, and the Main Street Expanded Loan Facility. So 3 different types of lending programs. Also, the PPP certification requirements, SBA FAQs number 31, number 37, number 39, number 43 hike, and loan forgiveness. And then we're going to have a very lively open discussion and address some of your questions that you've been sending in. This is the team of folks, myself, Todd Polinak, my partner Josh, and Steve. Again, we're not dressed this way. We may never dress this way again, but we are dressed. So I'm going to hand it over to my partner, Steve, to talk about the Main Street Lending Program. Steve, take it away.
Thanks, Todd. Good morning, everybody. Hope everyone is doing well on this Thursday. I'm going to go through briefly the Main Street Lending Program. There was some new information that was released last week on the 30th. Just a little bit of history here. Back in the second week of April, on the 9th, the Federal Reserve released a $2.3 trillion package, a historic package. The entire package was aimed at households, state and local governments, and small and mid-sized businesses, basically looking to bolster the economy with economic saving measures. As part of this package, there was a $600 billion facility, or really 3 facilities, under what's called the Main Street Lending Program. The guidance on the 9th, there were 2 facilities, New Loan Facility and the Expanded Loan Facility. The April 30th release saw a 3rd facility, the Priority Loan Facility, released, and we'll go through those details as well. Just understand these are traditional loans, so just taking a step back, a little spoiler alert here. If you got PPP funding, you are still eligible for these funds as well, but we'll go through that in more detail. And below it mentions that the launch date is to be determined. While we have some guidance, this program, you cannot yet apply. The application process will be done through your bank, and we'll go through which banks are going to be eligible lenders momentarily. As I was saying, these loans are not forgivable, but borrowers can use one, but not all of the facilities. So there's 3 facilities listed on the prior slide. You can't use more than one, but you can use the same one on multiple occasions, provided you don't exceed the maximum loan amount, which will be detailed in a further slide. Whereas the other programs, the PPP and EIDL, were SBA driven, this is actually part of the Federal Reserve. Hence, it's authorized under a different act. It's the Federal Reserve Act. And basically, the Federal Reserve Bank of Boston lends to a special purpose vehicle on a recourse basis. And there's a participation in this of 95% or 85% in the case of the priority facility, which means the banks will be on the hook for the remaining either 5 or 15%. The program right now is headed to last until the 30th of September, but the Federal Reserve and the Treasury may assess this and see if the program size, length, what have you, needs to be extended. But as of now, they're going to stop purchasing loans on the 30th of September. So we have about 4.5 months or so of this program, at least as it stands now. For those bankers listening, or even borrowers that are looking as to figure out which banks will be eligible, we've listed the eligible lenders here, and it's basically US-based banks, holding company savings and loans. So basically, at least as it's listed now, nearly all banks that you hear familiar with will be participating. But as I said, we'll see once additional guidance is set forth. The banks will be conducting an assessment of each borrower's financial condition. So that is a little bit different than what we saw before, especially under the PPP, where the ability or the requirement to repay the loan wasn't necessarily a requirement for eligibility. Here, they're going to actually be assessing the borrower's financial condition. And specifically for banks, if you have loans existing already, the loans will need to have an equivalent rating of pass, but that's something specific for banks. So not anything that borrowers will need to be concerned with, at least at the current moment, other than if you already have an outstanding loan. So more importantly, for those who are borrowers in any event, these are the eligibility requirements. The business has to have been established prior to March 13th, 2020. It's not an ineligible business, which we'll cover in a moment. And this is one of the increases as part of the new guidance that came out on the 30th. They actually loosened some of the restrictions and expanded the eligibility requirements, two of them being, whereas now it's 15,000 or fewer employees or 5 billion or less in 2019 annual revenues. The prior guidance was 10,000 or fewer employees and 2.5 billion or less in 2019 annual revenues. So they've expanded the eligibility base. So that's good for those on the larger size of midsize. The businesses essentially have to be created in the US or organized under US laws with significant operations and a majority of employees in the US. So they're essentially going to be US-based businesses. And as I said before, you can only participate in one of the 3 main facilities, and also cannot have been participating or plan to participate in the primary market corporate credit facility, which is something that basically a different facility that backs certain bonds and lending. The overall goal of these loans is to maintain payroll and retain the workforce. So that's something to keep in mind as well. And we'll discuss why that's important when we talk about prioritization and seniority of the loans. But the eligible borrowers cannot have received support under basically under subtitle A of Title IV of the CARES Act. But the PPP loans, as we mentioned earlier, are mentioned or referenced, or I should say included under a different title of the CARES Act. And therefore, if you have a PPP loan, you are still eligible to participate in these programs. Here's another kind of loosened restriction. Borrowers must make a commercially reasonable effort to maintain payroll and retain employees. The prior guidance indicated there were certain threshold levels. This is just saying borrowers need to have a commercially reasonable effort to maintain payroll, retain employees, which according to the guidance means that the eligible borrower should undertake good faith efforts to maintain payroll and retain employees in light of its capacities, the economic environment, available resources, and the business need for labor. And borrowers that have laid off or furloughed workers are still eligible to apply. So as I was saying, the businesses that are eligible, it's for-profit businesses. So as of now, not-for-profit entities are ineligible, but the SBA, I'm sorry, not the Federal Reserve and the Treasury may look at this and see if they can expand this to other entities, but as of now, they're not eligible. And we see some other types of businesses that are eligible, and here are the requirements as well. We also listed ineligible businesses. These are your passive businesses, your lending, certain clubs, entities such as that. If you look at the Federal Code of Regulations, there are other businesses listed here, certain government-owned entities as well. Just something to keep in mind. This is similar to the eligibility requirements associated with the PPP. So if you're wondering if you're eligible or not, that's a place to reference. Also, feel free to reach out to any one of us and we can offer you further guidance. So here's a chart for you that basically lays out the details of the program. The Main Street New Lending Facility and the Priority Facility are for newer loans originated after April 24th, whereas the Expanded Loan Facility upsizes or expands on existing loan. All 4 loans have a 4-year term with a 1-year deferral, but as you see, the minimum and maximum loan sizes do vary depending upon the program that you enter. And the risk retention, that was what I was mentioning before. So depending upon the program you enter, 5% to 15% will be risk retained by the bank. So the priority loans are for those borrowers that will have a higher leverage. As I was mentioning, you get a 1-year deferral. The terms here is listed under the payment aspect, talks about how it will be paid off over that 4-year period. And another change, the interest rate is now LIBOR based. The other one was the prior guidance had the standard overnight federal rate, but this is now LIBOR plus 3%. So it's something to keep in mind as well. As we were saying, these are traditional loans, so there will be an interest charge. Other details of the loan, no prepayment penalties. There are transaction and loan origination and upsizing fees as well, depending upon which program you enter. The banks may, in fact, charge these fees onto the borrower. So that's something we'll see once we get the application finalized as to what exactly the fees will be. And as we're saying, from a collateral perspective, they may be secured or unsecured, depending upon a bank preference and or the program or facility that you enter. So both the lender and the borrower have certain attestations and certifications that they need to make before participating in the program. There's a lot of words here, but basically this is saying that these loans are going to have top priority, top seniority, and until these are paid off, you won't be able to pay off others unless debt or interest is due under the terms or there's a default or acceleration. The lenders will commit not to cancel or reduce any committed lines of credit to the borrower except in a default. And the lenders are required to certify that essentially they're going to follow the EBITDA computation, which was referenced on the prior slide, and don't have any conflicts of interest issues. And for those interested, the EBITDA, that is earnings before interest, taxes, depreciation, and amortization, that will be looked at similar to how it was normally computed. So if there was some sort of adjustment that was made by the bank before when looking at EBITDA, that adjustment will be looked at as well. So if you are considering applying, I would suggest reach out to your advisor. Hopefully that's us, but if not, reach out to your advisor and make sure that you're able to determine what your 2019 EBITDA is, because that's going to be important in determining your maximum loan size. Borrowers, as we were mentioning, also have similar attestation and certification requirements, essentially a seniority item as well, and that you're going to have to repay these loans before other loans are paid off. And as we were saying before, the main purpose of these programs is to maintain payroll, retain employees. So they don't want you taking these funds and repaying other debts. They want you to use it to keep your labor force in purpose, which is kind of the whole goal of all these programs, essentially to keep people working while we get through this unfortunate pandemic. So these are the borrower requirements as well. There's you basically have to have certain financial obligations, certain financial strength, and aren't expecting to file bankruptcy. Additional borrower requirements, and we had mentioned these haven't changed that much, but basically following the compensation, stock purchase, and capital distribution requirement restrictions, basically not allowing certain highly compensated people to increase their compensation during the time that the loan is outstanding, or even those highly compensated, essentially making over $3 million, may actually be subject to a reduction in compensation. You won't be able to repurchase equity off the publicly traded market. And again, that goes back to what these loans are really intended for. They're intended to maintain your payroll, maintain your workforce, not to increase the strength of your balance sheet. But they did loosen up the capital distribution requirements and allow companies to make pass-through tax distributions. So owners of these entities are able to pay their taxes. And also, you have to certify that you're eligible to participate in light of any conflicts of interest prohibition, participation issues. So as I said, the application will come out soon, but in the interim, we wanted to provide you with that information. But going to now turn it over to my partner, Josh, to discuss the PPP certification requirements and all the information that's been out in the news. Josh?
Hey, thanks, Steve. Good morning, everybody. So I don't know whether I should call this the ever-changing, not so satisfying PPP program, the not so free money PPP program. But for those of us who have been, wrestling with this, and there's been a lot of information out there for the last 2 weeks, our friends at the SBA have extended us 1 week for additional torture. So just to kind of recap where we're at, if you remember when everybody applied, you attested to the certification that said the uncertainty of the current economic conditions makes necessary the loan request to support the ongoing operations. To me, makes sense. To you, probably makes sense. But really due to the program being rushed out so quickly, the SBA has put out there that additional clarification to this statement was needed, and they have added 4 FAQs, 31, 37, 39, and 43, that all again provide further clarification to the statement. Borrowers must make the above certification in good faith, taking into account A, their current business activity, and B, their ability to access other sources of liquidity sufficient to support their ongoing operations in a manner that is not significantly detrimental to the business. Will we ever get a definition as to what liquidity, what sufficient liquidity and not significantly detrimental to the business is? I would say probably no. However, in this, when they put out the FAQ 31, from our standpoint, and the example that they gave surrounded public companies, but still made reference to the fact that all applicants must consider the implications. However, 4 days later, with FAQ 37, they now expanded it to say businesses owned by private companies must consider these stipulations. Okay, so on that same day, April 2020, Treasury Secretary Mnuchin came out and said that all loans of at least $2 million will be reviewed by the SBA. What does that review include? When is it going to be done? Those are 2 huge questions that we have been asking, and hopefully they have indicated that further guidance will, come out with respect to that. However, internally we've had a lot of discussions with our clients. We've had a lot of discussions, I think either way you look at it, we know what's happening in our businesses today. We know the economic uncertainty. We see the challenges of the business. However, we also believe that 3, 4, 5 months from now, when the SBA goes to look at and actually review these loans, we know, or we believe, I shouldn't say we know, but we believe that the SBA will come in and play Monday morning quarterback. So where we're, as businesses, trying to project what the current situation looks like, the SBA most likely will look backwards and make their determination based upon that. One of the other things that the FAQs have done is they've essentially recused the lenders of any responsibility here. So if somebody in good faith submits for loan forgiveness and the bank passes the application up to the SBA, and the SBA finds that something is incorrect or wrong or wants to challenge something, they're going directly back to the borrower. They will not, go back to the intermediary. So as I mentioned before, they've extended the torture. So any borrower that applied for a PPP loan prior to April 23rd and now repays the loan in full by May 14th. Originally, today was D-Day, but they've given us till May 14th, will be deemed by the SBA to have made the required certification in good faith. And FAQ 43 also indicates that further guidance on the review of the certification will be issued prior to May 14th, 2020. So my guess is, in true typical SBA fashion, that will come out on May 13th, 2020, probably when all of us are sleeping. And again, borrowers that do return the funds by now May 14th, borrowers that return the funds by May 7, 2020 are eligible for the employee retention credit. The date may be extended to May 14th, 2020. I think that will make sense and be be consistent there. So, questions I think we all need to ask ourselves is, are we the intended recipients of these loans? So, questions you should be asking yourselves to determine if your business is an intended recipient include some of the following facts and circumstances. And also, can you prove that you had a reasonable belief that your business was or would be negatively impacted? So some of the questions you want to ask yourself: did you lose key customers or a significant number of customers? Or do you anticipate that you will lose customers? Did you have a valid basis to believe that customers would slow pay or become non-payers? I think here it's important to look at your trend of your customers. Have they historically been 30-day payers and now they're becoming 60, 90-day payers? Or were they always 120-day payers? And did you lack access to financial resources to be able to withstand a decline in revenue? Now, in our world, this could mean significant liquidity in the business. It could be access to line of credit. If you're a public company, which originally, the folks who left the black mark on this program, the ability to issue stock or sell debt or sell off a portion of the company, whether it be to another individual, to private equity. These are all questions that we should be asking ourselves. And again, can you prove the facts and circumstances with respect to the questions we just asked with written documentation? We're going to talk about that in a minute. But again, the SBA has said that they will review or audit loans over $2 million. It would only be expected that based on what they find during those review or audits, they potentially open it up to the whole population of loans and potentially spot check, certain loans. It is out there that, approximately 75% of all the loans are $175,000 and less. So again, I think the important thing here is not only to go through these questions in your head, but document it and have a strong basis as to why you took the money. And again, we talked about Monday morning quarterback. From the date the loan was made to ultimately where we're at today, to ultimately where the SBA may be looking at this 6, 7, 8 months down the road. Where is the business? Has it improved? Has it declined? So again, here, what if my business was not negatively impacted despite COVID-19 and I did receive the PPP loan? I think there's 3 things that you want to consider. One is if the business has improved financially with respect to the certification, serious consideration should be given as to whether the certification was falsely made. There is a consideration and an opportunity to go for forgiveness, or we can repay those funds. So we do have these 3 considerations to make in addition. Okay, so we talked about documentation and really solidifying our position as to why we're going to keep this money. So we've laid out several facts here. We'll go through them real quick. One is we talked about having access to capital outside the PPP. Do you have a line of credit? If you don't have a line of credit right now, good luck trying to get one. If you do have a line of credit and you need more money on top of it, good luck trying to get that. Significant cash reserves. Again, what does significant mean? And then other capital resources. Again, the ability to sell stock if you were a private company or if you were owned by a private equity firm. Do they have access to capital? That's really the $1 million question here. The next one is your business open? Again, living in the New York, New Jersey area, many businesses are not open. And if you are lucky enough to be open, are you operating with a reduced staff? And that could be due either to trying to observe social distancing rules, or just the volume of work is just not there. Did you have a decline in current sales and or a cancellation of future orders? I mean, we're seeing drops in sales anywhere from 20% to 40% to 60%. Really depends on your industry, your customer base, and potentially whether or not you sell an essential product. Have your receivable collections decreased and or have your customers requested more favorable payment terms? Again, look at your cash flow today, and by comparison, how does it look from this time a year ago? I would assume that all customers are taking more time to pay or just not paying you at all. Also too, supply chain issues, right? It may be a challenge to get product. Typically product that comes from overseas may normally take 3 months on the water. Now it could be taking 6 months. The materials which you needed may not be available to you at all because maybe the factories are closed. If you're fortunate enough to have product, you may not be able to deliver it. The customer may not be open, and reduced access to labor market. And Todd's going to talk about that a little bit later. But when this first happened, companies laid off a lot of people, and those people went on unemployment, and some of them may very well not be looking to come off of unemployment. So, like I said, we're going to talk about that in a little bit. And also, too, are your customers or vendors applying for PPP funding? Again, if we're following the certification and we're in need of these funds, if your customers and vendors are applying for these funds as well, to me, that's a clear indication as to the climate that we're really in. So again, there's a lot more things than this, but again, sufficient documentation to support your position is very important. So in addition to the documentation, what we think is very valuable to support your position is to put together a cash flow analysis. Do it 30 days from now, 60 days, 90 days. Carry it out to the end of December and really project out your cash flow, taking into account the slowdown in receivables. If you don't have access to a line of credit, what that does to the business. If you need to make layoffs or furloughs because the cash isn't there to support the payroll. If you have to make any debt repayments on your existing debt, and then again, projected expenses and other cash disbursement commitments. These are all things that should be captured within your cash flow analysis. And again, the point is to show that here I am as of today. Here's where we expect to be in the future, and we expect to have a decline in cash as a result of this climate. And then finally, the most important thing is that this documentation should be reviewed and approved by the owner, top management, and the board. And I think it's very important to timestamp when these things are being the documentation, cash flow, because again, we're operating as if how things are going to change going forward. Remember, somebody looking at this 6 months from now is going to look backwards. So it's a lot easier to prepare this documentation today when you're in the heat of it than it would be to prepare 6 months from now. So at this point, if you are keeping money, how do we get this loan forgiven? Todd, this is your area. Take it away.
Okay, loan forgiveness. I can remember when we did our very first webinar, we said that this PPP was free money. Well, there's a bunch of folks that have given back that free money, I've been told. But let's talk about what we know right now about loan forgiveness. And folks, we're doing this as a recap because we want to keep it fresh in your mind and also address the things that we know and that we don't know. And yes, it is absolutely true that the SBA has promised that they're going to come out with additional guidance on this. So stay tuned. We're going to talk about the different steps. The first step is to start with your eligible costs that are forgivable, that are spent in the 8-week period that begins the date that you get the money deposited in your account. And that's payroll costs that must be at least 75% of the forgivable loan amount. And then certain non-payroll costs that are capped at 25% of the forgivable loan amount. And they are interest on mortgage obligations, rent, utilities, and perhaps we'll talk a little bit about that later. Step 2. So after you have your eligible costs, you're going to apply a formula that considers any workforce reduction. And the formula is A divided by B, A being the average number of FTE employees during an 8-week period beginning with the date of the loan origination, and B, the average number of FTE employees from February 15th, 2019 through June 30th, 2019, or January 1st, 2020 through February 29th, 2020 at your discretion. So A divided by B multiplied by that eligible amount. And we thought it was so important that we put the caveat on both slides. The SBA still needs to come out with additional guidance. Step 3, decrease amount $100,000 limit. And step 4, for the period from February 15th, 2020 through April 26, 2020, which has passed, where there was a decrease in the number of FTE employees or wages, you restore the FTE employee count or wages by June 30th, 2020 to the pre-February 15th, 2020 status. Okay, so here's some open questions, and one or two that have been answered that we'll highlight too. Still unclear, folks. Please, please, please don't believe everything that people are writing on the internet, no matter whether it's a law firm or an accounting firm or whatever, because there's still a lot of unknowns and it's all open to interpretation until the SBA comes out with further guidance. Will the 8-week period be extended? Are the costs for the 8-week period to be determined on a cash basis or an accrual basis? At least 75% of loan proceeds shall be used for payroll cost, it says, but what happens if I spend less than 75%? Does that mean that none of the loan is forgiven or forgivable? Should full-time bonuses and or year-end profit sharing contributions be included in the forgiveness calculation? Does rent cover only costs for facilities, or do equipment rentals count as rent for forgiveness purposes? How is the full-time equivalent calculated? There are some people who are guessing. How are non-COVID-19 reductions in workforce and or salary treated for purposes of the loan forgiveness reduction? Will the formula for salaried reduction be pro rata adjusted? And do the exceptions for headcount and or salary reduction allow for a replacement of the terminated employer? Some more questions that the SBA needs to answer, or maybe they won't. What types of transportation costs qualify as utility costs? For employees rehired by June 30th, is there a time period for which they need to be employed in order to count towards the headcount / salary restoration? That's the infamous, can I fire them on July 1st at 10 o'clock in the morning? Will the expenses associated with the forgiven funds give rise to a tax deduction? Now, per the IRS Notice 2020-32 that was issued on the infamous April 30th, 2020, expenses are not tax deductible, but that may be reversed. We don't know yet. Will the forgiven funds be tax exempt for state tax purposes? Not clear. How will PPP forgiveness be impacted if a laid off employee declined rehire opportunities? So this is a question that came up, and actually if you go to the SBA website, the Q&A for number 40 in that top lineup, the SBA and Treasury will issue guidance indicating that forgiveness will not be reduced if the borrower makes a good faith written offer to rehire the employee. So if you do that and they turn it down and the documentation of the employee's rejection is kept, and the employee knows that they may forfeit eligibility for in continued unemployment compensation, it won't act against you. So that's one question that has been answered. So now I'm going to give this over to Josh because he loves to have open discussions. So Josh, will you head off and start the open discussion piece of this webinar?
Hey, Todd, sure. So just to bring everyone up to speed on a couple things. One, there was an article out there the other day with respect to the first criminal investigation into the SBA programs. 2 men in New England were charged with misrepresenting to the SBA employees who did not exist in their payroll cost computations. So it sounds silly, but make sure we're only including folks who actually work for the company. The second point is there was some information that came out this morning. If you are a not-for-profit and you have a PPP loan, the PPP will not be subject to uniform guidance. It's deemed to have been distributed by local financial institutions. However, if you are a not-for-profit and you've received an EIDL loan, economic injury disaster loan, that loan is being considered as a federal loan from the SBA and subject to uniform guidance. So Again, just to reiterate, PPP is not included as part of uniform guidance. However, EIDL will be. And the last open point I just want to make, there are certain banks out there. We've seen some emails requesting additional certifications be made of the borrower at dollar amounts that are not specified by the EA, and neither are these additional certifications. So it is a bit puzzling and interesting as to why some of the banks are asking folks to do this. If you do get something and it doesn't look right, certainly ask the question. But again, these are, as far as we know and what we've seen, there's been no change as to the required certifications by the SBA, other than what was clarified as we discussed before in FAQ 31. So those are kind of some of the things that are happening. We want to thank everybody again for their time today. And of course, please continue to submit your questions through the mail, covid19@sacsllp.com. Please feel free to visit our resource center found on our website. And as promised, we will be back next Thursday, 10 a.m. to hopefully have more of an update on forgiveness. We're hoping that with the application process behind us, that finally we start getting some of our questions answered with respect to forgiveness. With that, thank you for joining us. Be healthy, be safe, and we'll see you back here next week. Take care.